Today I want to have a look at Lilly, which over the past 5 years is up by 580%. Now the reason why this company is up by so much over the past 5 years is that it is the main producer of the weight loss drug alongside with Novo Nordisk. And so today I want to figure out if this insane rise in price is rational and if the company is set to keep rising over the next few years or if it will fall. And as always, to figure this out, we will use our stock valuation spreadsheet, where we'll have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of the company using our 4 valuation models. Now jumping straight back to the stock screener, I've already plugged in the ticker and we can see that Lilly is a dividend company. They currently have a dividend yield of 0.64% with a dividend payout of $5.20 and a very high trailing free cash flow payout ratio of 93.81%. And this is something that very scares me when looking at the company, as this means that after paying out their dividend, the company has only 6% of their free cash flow to push into innovation, buy back shares, and pay off debt, which is very, very little. Especially for a company in the healthcare sector that has to push a lot of their free cash flow into innovation and into manufacturing new drugs. So this is the first big red flag for me. But let's have a look at the 9-pillar analysis and we can see that the rating isn't much better. It is sitting at 4 out of 9. We can see that the 5-year PE ratio and the price to free cash flow over the past 5 years are both sitting above the ranges we like to see. The price to free cash flow is sitting at 110, which means that investors are paying $110 for every single dollar of the company's free cash flow, which is more than 400% what they would pay for an average company. So let's have a closer look at these two metrics. Let's first have a look at the 5-year PE ratio. Wow, so on average it has been sitting at 35.16, but currently it's sitting at 87.95, so that is extremely overvalued, and it has been growing at a rate of 35.18% over the past 5 years. Now looking at the free cash flow that is sitting at 925, we can see that from 2019 to about 2021, the price to free cash flow was sitting in the range we'd like to see, but in 2022, 23 and 24 it skyrocketed as the stock price went up. To me that is just ridiculously expensive. But let's have a look at their growth. We can see that their revenue has been growing at a rate of 13%, their free cash flow has been decreasing at a rate of 9.5%, and their net income has been decreasing at a rate of 10% over the past 5 years every single year. Now if we have a closer look, we can see that the revenue has actually been increasing at a rate of 13%, increasing from 22.3 billion in 2019 to 34.1 billion in 2023. Now looking at the net income, which has decreased from 8.3 billion in 2019 to 5.2 billion in 2023. And regarding the free cash flow, that has decreased from 3.8 billion in 2019 to only 792 million in 2023. So far it really isn't looking good with Lilly. They are trading extremely expensive and they aren't really growing at all. Now they do have a high 5-year profit margin sitting at 77.58%, and they have decreasing shares outstanding at a rate of 0.69%. Now normally I would be happy that a company is decreasing their shares outstanding, but with Lilly it just doesn't make sense. As they are currently trading so expensive, it would make more sense for them to sell out more shares and generate more free cash flow. Instead they are buying back shares from the very little free cash flow they have left after paying out all their dividends. Now before we continue, I just want to say these spreadsheets are very useful to both beginner and advanced investors. Whenever you see a company on the internet that interests you, you can simply jump to these spreadsheets, plug in the company's ticker, figure out its intrinsic value, and go through the 9-pillar analysis and understand whether it is worth researching this company further to possibly add it to your portfolio, or whether the company is simply not worth your time. And currently we are running a Christmas discount. You can find the discount code in the description. It's a discount for 20%, and if these valuation spreadsheets interest you, you can pick them up right now. Now going back to the 9-pillar analysis, we can see that the long-term liabilities over the 5-year free cash flow negative dividends is actually sitting in the range we like to see. It's sitting at 1.64. And what this metric tells us is whether Lilly generates enough free cash flow to cover all their long-term liabilities while paying out their current dividend, so they don't get into trouble with debt or don't cut their dividend. Now, a ratio sitting at 1.64 means that Lilly can pay off all their long-term liabilities in about 7 to 8 years, which is nice. But they have been growing their long-term liabilities at a rate of 12.44% yearly over the past 5 years, so that is something to look out for. And they have actually increased them by 44% since 2023, and currently they are sitting at $35.1 billion in total liabilities. And as their free cash flow isn't growing but rather decreasing, again, quite a big red flag. Now, finally, let's have a look at their consecutive dividend growth, which is sitting at 14.30%. Now, personally, I think that Lilly shouldn't pay out dividends at all. As we saw at the start of the video, their free cash flow payout ratio is extremely high. And now we can finally get to calculating the intrinsic value of the company. Now, first jumping to the Graham's formula revised, we will calculate the 5-year earnings growth estimate. Now, the analysts do project about a 60% growth in the company's earnings in the next 2 years, but I don't quite agree with that. So I plug in my high earnings per share growth estimate at 20%, medium at 18%, and low at 15%, averaged it out with the analyst projections, and got a future yearly growth rate at 34.81%. Then I took all these values and got an intrinsic value of $437.24, which is 86% lower than the current trading price of the company. Now, moving to the second valuation model, the discounted cash flow model, where we take the free cash flow of the company over the past 5 years and calculate the negative average growth rate. Now, again, I predicted the free cash flow growth, the highest at 15%, medium at 12%, and low at 9%, and got an average predicted growth rate of 12% yearly into the future. Now, using that, I calculated the future free cash flow and plugged in a discount rate at 4.4% to calculate the present value of that future free cash flow. Then I summed all of that up, added cash and cash equivalents, and subtracted the total debt. I got an equity value which I divided by the shares outstanding and got an intrinsic value of $665.96. Now, for the next valuation, we compare Lilly to 3 of its competitors, so pharmaceutical companies. Now, we will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. Now, we can see that these 3 companies' PE ratios are extremely lower than the PE ratio of Lilly, and so when we average them out and multiply by the earnings per share of Lilly, we get an intrinsic value that is fairly pathetic, $161.11, much lower than the current trading price, showing us that Lilly is indeed very overvalued compared to the earnings they generate. Now, moving to the final valuation model, the dividend discount model. As I said before, I believe they will have to cut their dividend, so I project a growth rate of 6.67% into the future. And as this percentage is higher than the percentage of the discount rate we plugged in our discounted cash flow model, the valuation doesn't work due to the mathematics within. So we have to use our alternative model, where we project the next year's dividend using our projected growth rate. We take the stock price next year predicted by analysts and the discount rate and get an intrinsic value of $926.42. Now, moving to the final valuation, the ultimate intrinsic valuation, where we average out the 4 valuation models and get an intrinsic value of $547.68, which is 32.66% lower than the current trading price of the company. Now, based on this valuation, I really don't think that Lilly will manage to sustain their current trading price. I rather think that they will fall in price during the next few months or years. And with that, if you enjoy this valuation, make sure to leave a like and subscribe, as it really helps me out.